Okay, so let's proceed and look at some more examples. So again, there's the sort of things that you can itemize. Okay, so let's say the standard deduction, you believe that you can beat it. You are going to look at these that may be applicable in your situation. So for most people, medical expenses will go to the doctor, we pay out of pocket and so on and so forth. These must be from an authorized physician. Over-the-counter medications don't work here. And the AGI comes in here. The expenses that can be included in your itemized deduction, your Schedule A, have to be up to at least 7.5% of your AGI. Above that, so anything below 7.5% of the AGI cannot come here. State and local taxes that we pay to the government or local government, and then state government would also be part of a property that we own, like cars and homes. You are going to be able to include those numbers. Sometimes you could also use sales taxes to also arrive at the same thing, but most people just use the property taxes that they pay directly to the government. We'll work an example in just a minute. Interest expense. So for our principal homes and the secondary home, the mortgage payments, the interest portion of it, and also investments interest of it. Okay, so you would be able to include those here as part of your itemized deduction. Charitable contributions as well. Again, AGI limits apply depending on the type of property that we are donating. Okay, so we'll work again an example in just a moment. Casualty theft. Now after 2025, the federal government still has to declare that and give you a number, and then all losses that occasion as a result of the casualty is going to be also be part of the itemized deductions. So you can see that these are very restrictive. If you have them, great, you'll be able to use them and see if you can further reduce your tax liability. That again, remember, the standard deductions have been increased recently, so a lot of people find it easier to use that. Alright, so now let's look at some examples, a few scenarios to see how the itemized deduction work, or the Schedule A deductions. Let's talk about Mr. Kwame Nkrumah here. He made 7,000 cash contribution to the local United Way. Mr. Nkrumah's AGI, so again, for taxes and AGI to go together, almost synonymous, $115,000. Okay, he's giving $7,000 in charity cash, and his AGI is $115,000. How much of the cash contribution can he deduct as an itemized deduction? Okay, so what for cash contributions, the limit is 60% of your AGI. So if Mr. Nkrumah gave all of his income charitable contribution to the United Way, he would only be able to take as a deduction up to 60% of that. So if we calculate that, 60% of his AGI, it is $69,000. 115 times 60% is $69,000. He gave $7,000, right? So that means that he can take all of that as part of his itemized deduction. Received $800 or paid $800 in interest expense on the loan that he took, right? Now the thing with interest is that the expense cannot exceed the interest income or the investment income. So in this case it was $800. He received an income that would have been included, as we saw, gross income, interest income is part of it, so it's already been included in this 115%. Assuming they are related, he will be able to take this also as part of his itemized deduction. All right, so he has $7,000 here, he's going to get $800 here to increase that. Mr. Nkrumah also paid $4,500 in real property taxes on a vacation home which he used exclusively for personal use. His home qualifies for itemized deduction for those taxes that he paid on. But remember, it's right, these are what they call the SALT taxes, state and local taxes. It used to be $10,000. It's just been increased to $40,000. So he's going to now start counting. There's $4,500. It goes towards these two, but it's also going to be limited by $40,000. There are other things that would be part of it. Okay, so he can also include $4,500 as part of his itemized deduction. Part of his mortgage of $375,000. He paid in interest $9,520. So how does that also work? The mortgage interest on mortgage loan up to $750,000 qualify for a deduction. Okay, as long as the value of the house is not more than $750,000, the entire interest on the mortgage is That's also a qualified deduction for itemizing. So he can include that. Now, Mr. Nkrumah spent $14,300 to restore his receding hairline that he felt was necessary for him to compete with young colleagues at work. Now that, we need to think about it. That's an elective procedure as a cosmetic surgery, and unfortunately he paid handsomely for it. And great, he's going to look great, but it's not deductible. So he can take any of that towards his itemized deduction. Mr. Nkrumah's W-2 showed $5,345 has been withheld for state income tax, and his car registration document showed $214,000 as potential tax deductible. Okay, so these are property taxes, and then also state income tax. This is part of what we're talking about. So you'll be able to include both of these as part of his itemized deduction. But again, this also goes towards that $40,000 we mentioned earlier. And so he's still not there yet, but he needs to keep an eye on that. If had it been 2024, he would have been limited by the $10,000 deduction limit. Good that the new tax law has increased it to $40,000. So he can still use that $5,345 plus the $214 to get $5,559 also as part of his itemized deduction. Now let's put all together to see how much he's, right? So the $7,800, $4,500, $9,520, $5,559, all of that gives us $27,379. Is he going to be able to take all of that? It depends. It depends on his filing status. So let's assume a couple of scenarios. If you are single, as I showed you, single standard deduction, right? $15,750. So that is what he'll be limited by. If he's head of household, in other words, he has a dependent with him in the house, it's going to be $23,625. So in either of these cases, he's better off itemizing, taking the itemized deduction, $27,379. He'll be able to reduce his income by this number than these other, right? Because this is bigger. It will reduce his $115,000 much further down than if he chose the standard deduction. So by itemizing, given these filing statuses, he's better off. On the other hand, if he is married and he's filing joint, remember, married filing joint, the standard deduction is $31,500. So in that case, this is small. $27,379 is small. So he would not benefit from itemizing. He is better off just taking the deduction for married filing jointly. Okay. So in that case, itemizing does not help him. So this is how it works. Okay. So this is a good practice. All right. So again, if you like this stuff, scan the QR code. Thanks for your time. Bye.